All right, today we're doing a deep dive into something a bit different. Investing. Like a pirate. Treasure maps for wealth building.
Hmm. It
Yeah.
sounds kind of wild, right? Getting investing lessons from pirates?
It does, yeah. But it's surprisingly relevant.
So we're going to unpack 5 key ideas from this source.
Yeah.
Principles from the high seas that, well, actually apply pretty directly to your finances.
Exactly. And I think what's so valuable here is that looking at it from this, unconventional angle, it really forces you to rethink wealth building.
Mm.
It's not just a fun metaphor. It's about taking a mindset, a strategy that worked in really unpredictable situations and seeing how it fits your own portfolio.
Gets you thinking differently.
That's where the real insights often come from, I find.
Okay, so let's get into it. The first pirate principle, the map. Having a plan. Pirates didn't just drift around hoping for the best. They had maps, specific routes, clear goals for where the treasure was.
Right. But here's the key thing, I think. A pirate's map wasn't set in stone. It had to be dynamic.
Dynamic, how so? Well, think about it. Changing tides, storms, maybe another ship showing up unexpectedly. Their plan, their map, had to account for that.
Ah, okay. So it's not just having a destination.
Exactly. For your investing, your map needs that same flexibility. A clear goal, yes, but also, adaptable enough to handle market swings or new opportunities.
So you can course correct without losing sight of the main goal.
Precisely.
Yeah.
It's active navigation, not just setting a course and hoping.
That adaptability piece is huge, which kind of leads perfectly into the next point, doesn't it? Risk and reward, balancing the potential bounty. Pirates were masters at this. They knew raiding a ship was dangerous, cannon fire, fighting back, maybe losing their own ship.
Serious consequences.
Yeah, so they had to weigh that potential treasure against the very real risks, the cost.
And this brings up a really important question for you as an investor. Are you really calculating the full cost?
What do you mean the full cost?
Well, pirates faced losing everything, right? For investors, the cannon fire isn't always just market drops. Often it's behavioral risks.
Like fear, greed.
Exactly. Making impulsive moves. Those things can sink your capital faster than a bad market sometimes. So it's not just about volatility numbers. It's about understanding the real downside.
And asking yourself, am I truly prepared for that worst case? Or just kind of hoping it won't happen?
That's the core of it. Really understanding the stakes.
Makes sense. Okay, so once they got the treasure, pirates didn't just pile up gold coins, did they?
No, definitely not.
Which brings us to principle 3, diversification, spreading the loot around. They took gold, sure, but also spices, cloth, jewels. I read even livestock sometimes.
Yeah, whatever had value.
Yeah.
They understood, maybe instinctively, that putting everything in one basket was too risky.
So for us...
Well, the message is pretty clear. Don't be a one-asset investor.
Right.
And diversification, real diversification, it's more than just owning different stocks. It means spreading your money across different types of assets.
Like stocks, bonds, real estate.
Exactly. Maybe some alternatives, too.
Yeah.
The idea is to spread the risk so that if one part of your cargo takes a hit, it doesn't sink the whole ship, financially speaking.
Smooths out the ride a bit when things get choppy.
It really can.
Okay, navigating choppy waters requires something else too, which is the 4th principle. Patience. Waiting for the right moment. Pilots apparently could be incredibly patient. They might wait, for months sometimes.
Just watching.
Yeah, just observing, waiting for the perfect target ship. Because jumping too soon could be a disaster.
And in investing, patience plays out a bit differently, but it's just as crucial. It's not really about timing the market perfectly, like trying to buy the dip every single time.
So what is it then?
It's more about discipline. Staying invested long enough for compounding to really do its work. That magic of growth over time. So many people sabotage themselves by chasing quick wins or panicking when things go down. Real wealth usually builds steadily, not overnight. It needs time.
Like waiting for the right tide almost?
Kind of, yeah. Letting time work for you.
All right, final principle. Number 5, sharing the spoils. Building your crew. We know pirates split the treasure, right? It kept the crew loyal, working together.
Absolutely. Their success depended on the whole crew working as one.
So how does that translate?
Well, I think it broadens out really nicely. It's about not hoarding your financial knowledge or your successes.
Meaning?
Teach your kids about money. Share what you learn with your friends, your community. Maybe mentor someone who's just starting out. Build a crew around you where everyone benefits.
So it's not just about your own treasure chest.
No. Financial well-being doesn't have to be a zero-sum game. When you share knowledge and support each other, You kind of lift everyone up. It becomes a shared journey.
That's a great way to think about it.
Hmm.
So wrapping up, maybe the questions you should ask yourself, inspired by these pirates, are, do I have a map, a plan, but is it flexible? Am I really thinking about the real risks, the cannon fire?
Hmm.
Am I spreading my assets out, diversifying properly? Am I patient enough to let things grow? And am I sharing the wealth, the knowledge, building my own crew?
Yeah. And maybe one last thought to leave you with. Beyond just growing your own wealth, think about that crew aspect, how sharing what, empowering others financially, how that actually creates a stronger community, kind of collective wealth.
Interesting.
That collective success, maybe that's the ultimate treasure in the end, something bigger than just your own account balance.